Well, it's time to move to the last session of the evening and perhaps the most awaited one. The next discussion would be on demand, supply, and price of precious metals. We have four most sought after market researchers, analysts, strategists who, in my opinion, between them have a cumulative experience of over 110 years in the precious metals market. It's indeed a pleasure to welcome the distinguished panelists, Mr. John Reid, Chief Market Strategist, World Gold Council, Mr. Trevor Raymond, Director of Research, World Platinum Investment Council, and Mr. Bart Melek, Head of Commodity Strategy, TD Securities from Canada now. Very good morning to you, sir. The chair of the session is none other than Mr. Nikos Kavalis, MD Singapore Metals Focus. The question to the panelists is it time to trim exposure in precious metals? Before I hand over the session to Mr. Nikos Kavalis, a brief introduction about each of the speakers. Starting with Mr. Nikos. Mr. Nikos is the founding partner of Metals Focus. He has over 17 years of experience as metals analyst strategist with GFMS and the Royal Bank of Scotland. Our first speaker on gold, Mr. John Reid, joined the World Gold Council in February 2017 as Chief Market Strategist. He is responsible for producing strategy, developing insights on gold market, leading our global dialogue by engaging with leading economists, academics, policymakers, fund managers, and investors on gold, and leading our research team. Mr. John Reid has over 30 years experience in gold industry and related fields, most recently as a partner and gold strategist with Paulson and Company for the past 7 years. Prior to that, he worked as a precious metal strategist at UBS for 10 years, a gold equity analyst in South Africa for 5 years, and over 8 years held various positions in production project evaluation in the gold division of Glencore, then a leading South African mining house. Mr. John Reid has a degree in mining engineering from the Royal School of Mines, a constituent of Imperial College London. The next speaker, Mr. Trevor Raymond, leads research and investor development for World Platinum Investment Council. He joined the Anglo-American Platinum, where he was the head of market intelligence and market relations. A precious metal specialist with over 30 years experience in equity and metals market, Mr. Trevor moved into the platinum industry in 2000, following 17 years in gold mining, which saw him undertake roles in engineering, mineral economics, and corporate finance. Mr. Trevor was Anglo-American Platinum's head of investor relations until 2008. Then he joined the Platinum marketing team in London to focus on commodity research and market development. The last speaker of the evening is Mr. Bart Melek, who is the head of commodity strategy, TD Securities. Mr. Bart Melek has 20 years experience analyzing global precious metals market, base metals, energy, and financial markets, as well as North American and global economies. He has worked closely with commodity, equity, and FX trading desks in Toronto, New York, Chicago, London, and Singapore, and has several forecasting distinctions and top global ranking to his credit. Mr. Bart contributes to TD Securities' strategic view by providing commentary on commodity and various other financial markets and how they relate to the sectoral and macroeconomic outlook. Mr. Bart has also a sought-after media resource for many leading print publication and business television programs, including Bloomberg, Reuters, CNBC, BNN, Global, and The Mail, the Financial Post, AFP, BBC, the Wall Street Journal, and Barron's. His forecasts are also part of the global consensus. Mr. Bart Melek holds a master's degree in economics from York University in Toronto with a specialization certificate in international finance and banking. With this introduction, I hand over the session to Mr. Nikos Kavalis, Managing Director, Singapore Metals Focus.
Many thanks, Vatsa. First of all, thanks everyone for joining us today. And of course, many thanks to the conference organizers, SPMA, Chinese Gold and Silver Exchange, Enterprise Singapore event, for hosting this event and keeping the community alive even during even during these challenging times when most of us haven't seen the inside of a business class lounge in at least a year. I would like to give some special thanks to Albert and Vatsa and their team for all the hard work they've put to this, and of course for inviting me. It's as always a great honor to be here. So today I've been asked to moderate a panel on just general trends on demand, supply, as well as prices for precious metals. And for those of you that didn't notice it, there is actually a subheading in the title of the session. Is it time to trim exposure in precious metals? And I'm sure myself and my esteemed panelists are going to wax poetic for a while about this, but in the meantime, I would be quite interested to see what everyone that's attending this event thinks about that. And in that vein, we have created a little poll, which you can access through the platform. If you click that little pointy finger next to join session, you can please contribute. It will be running for another half an hour, 40 minutes, and by the end of it, we'll announce the results. So I think with this, it's time to stop listening to me speak and time to pass it to my friend John.
Thanks very much, Nikos. And I'd just like to echo your thoughts. It's a pleasure to be here today. And thank you very much for the organizers of, I like the expression, keeping the precious metals conference industry going, although I suspect many people on this call have been doing quite a lot of these types of things during lockdown. Before I start the presentation, I'd like to address actually the question posed in the title of the conference. Is it time to trim precious metals exposure? And I think the answer comes down to, I suppose, it depends. Depends how much you've got. It depends what you own them for. We would very much make the argument that gold has a strategic role in portfolios. So a gold exposure depends on your portfolio itself, but a gold exposure of somewhere between 5 and 10% makes sense all the time. Now, clearly, you can have tactical tilts around that strategic exposure. And for those people that saw the coronavirus crisis developing and increased that tactical exposure last year, they did very well because gold was one of the best performing assets out there. We certainly did see quite a lot of position trimming take place after the really good news came out about the vaccines, principally in November. And I think by looking at flows in the market, that continued through till around about April. So I think, based on certainly on observations of what other people have been doing, that trimming of precious metals, specifically gold, may have run its course. And I think that's one of the things that we're seeing in the price action now. Other work we've done suggests that gold is not the best performing asset, even amongst commodities, in the period immediately following the end of a US recession. And I think the underperformance of gold compared to more industrial commodities makes a lot of sense. The work goes on to show, though, that 12 months, 24 months, 36 months after the end of a US recession, gold catches up. So personally, I think everybody should always look at their exposures and think about what they're trying to achieve from a tactical positioning. But I think that the performance that we've seen since November is entirely consistent with people reducing their exposure to precious metals, gold specifically. So I'm going to run through a brief presentation, if I can work out how to share my screen, which is always quite amusing. It's not going to take very long. It's really the highlights from what we saw in the first quarter in precious metals, with a few updates verbally from what we've seen since then. We saw gold underperform and deliver negative returns in the first quarter. One of the tools we have on our website looks at short-term return drivers of gold. And it breaks down into these 4 categories of economic expansion, risk and uncertainty, opportunity cost, momentum, a residual, and then gold's return. And if you look at the drivers that saw gold performed poorly, there's really two of them. And the first is rates. So in other words, moves in US Treasury yields particularly, and then moves in the US dollar. So still a lot of risk aversion around, risk and uncertainty around, which helps somewhat. But mainly, this was the increase in rates that we saw in the first quarter. When you look at fundamentals, I think we've seen beginnings of a return of the gold market to more normal conditions. And what do I mean by that? 2020 was characterized by extraordinary investment flows and extraordinarily weak consumer demand, particularly around the middle of the year. Now, towards the end of the year, we saw consumer demand recovering and somewhat less investment demand, particularly from ETFs. And that's really continued into the first quarter. So the beginnings of the rebound of the global economy saw consumer demand very strong, particularly jewelry demand, India and China. Bar and coin demand helped as well. Negative ETF flows and still buying from central banks. So picking up on a couple of those, you can see here the continued recovery in jewelry demand we saw in the first quarter. And although Q1 21 was down on Q4 2020, that's very much a seasonal effect. Year on year, it was a very strong performance, and as you can see, not completely out of line with what we've seen in other first quarters. India, China, and the rest of the world all contributing to this improved performance. Now, as we've already heard today, the second wave of the coronavirus pandemic, which has been affecting India, has resulted in a big shutdown in much of the country. That's going to result in quite a lot of impact on the gold market. But I think that the instructive thing to me is how gold demand performed in the fourth quarter and the first quarter of this year, really giving a decent indication that there is pent-up demand waiting on the sidelines. So when the Indian economy opens up again, and I know the cases have fallen quite sharply in the last few weeks, I'd expect to see a resumption of that strong recovery in demand that we've seen. ETF flows were negative in the first quarter. And to a certain extent, I think that's a bit of a correction from the very strong inflows we saw in 2020. Definitely saw some money coming off the table as I announced previously. What we have seen, however, is in April, those outflows slowed. And by the second half of April, we're seeing inflows again, and May delivered a positive number. So far, when I last updated it yesterday, it was roughly flat. So I think an indication that the profit taking that we saw really developing since November last year may have come to an end, and with real rates heading more negative again, as I say, the sentiment towards gold seems to have changed. Bar and coin demand posted a really strong number, and this is interesting because last year we saw bar and coin demand a bit weaker than you'd expect, simply because the markets were closed, where people would traditionally buy bars and coins in developed markets. We did see decent bar and coin demand out of the Western markets last year, and that's really continued into this year. So the first quarter of 21 had this combination of still strong developed market demand combined with recovering emerging market demand. Now, obviously, India in its lockdown will have an impact here as well, but we are expecting to see reasonably good bar and coin demand this year, and offsetting probably some weaker ETF inflows. The central bank story has been an interesting one over the last few quarters. We saw actually negative net purchases, in other words, net sales by central banks in the third quarter of 2020. And that has led to some causes from concern in the media and the commentators of gold, etc. But we've been saying consistently that we continue to expect central banks to be net buyers of gold, although probably not the really strong numbers that we saw in 2018 and 2019. So net purchases continued in the first quarter and have continued since then, with very decent buying coming in the second quarter from the Bank of Thailand, which you will have seen widely reported. So the outlook here is, I think, one of continued normalization. It'll be uneven. countries can have and will have, I expect, further outbreaks of the coronavirus until we all get vaccinated. I don't know, perhaps sometime towards the end of next year, globally. India's had a bad impact from the second wave of the coronavirus, which now seems to be easing. In the UK, we're into I'm not even sure whether it's the third or the fourth wave, third, I think. But certainly things have gone backwards here in the last few weeks, months. And I think that's an indication of what may lie ahead for other markets where, we're not out of the woods yet. This is going to have an impact on gold demand and probably less of an impact on supply. We'll see investment demand in gold this year. We've seen it already and we'll continue to see it. It probably is going to be at a lower level than we saw in 2020, whereas the consumer demand will recover to a greater or lesser extent, depending on disruptions from the coronavirus. As I mentioned, moderate rather than super strong net central bank purchases should continue. And on the supply side, we saw a very strong performance from supply in the first quarter of 21. Particularly from mine supply, where mine production was at a record high for a first quarter number. But that was moderated by some de-hedging, but also quite a big fallback in recycling. And I think that's an interesting component of the gold market, which doesn't get enough attention. Yes, recycling flows did increase in 2020, but only by about 1%. And that's probably lower than you would have expected. Considering the increase in the gold price. And then by the first quarter, they were down sharply. So I think that there's a lack of supply of recyclable jewelry demand out there, which may mean that recycling comes in quite a bit weaker in 2021 and will perhaps counteract some of the increases coming through in mine supply. So with that, I'm going to stop and hand back to Nikos. Thank you very much for your time.
Thank you very much, John, with your very detailed review, as always. It was very insightful. And I think we can now, having looked at what we're looking for in the gold market, I think it's time to turn our attention to one of the white metals. And I would like to invite Trevor to give us his view of the platinum market.
Hi, Nikos, and thank you for that. And good day to everybody around the world from me. I think I'd like to do just what John did, and that is address the question, should you lighten your exposure to precious metals? Well, I think platinum's got the benefit of being basically a precious metal as well as an industrial metal. So I do echo John's sentiments. It depends why you're holding it. A lot of people that were holding gold or did switch some gold into some platinum. But I think the real issue is that if you look at the previous global financial crisis, the weekly returns of platinum outperformed those of gold by as much as 60% for the next 2 years from 2008 to 2010. And I think that's something that we're starting to see. So platinum does certainly offer that linkage. And then separately from that, there are a lot of other aspects about platinum responding both to its being undervalued as well as its link to its industrial uses. So I think, a careful look. There's a lot of new investors that potentially haven't owned gold or platinum before. Gold is quite tough to get your head around. Platinum does have a supply-demand balance that's easier to understand in terms of its industrial applications. And as we heard earlier from the CEO of the World Gold Council, gold, 76% of demand is investment, whereas with platinum, it's been very small and grown to as high as 15%. So certainly a slightly different metal. So I'll take you through briefly what we see. And just going to the first slide, for those of you that don't know us, let me just tell you about the World Platinum Investment Council. Let's see if you could just advance the slide, that'd be great. So the World Platinum Investment Council was launched in November 2014 by 6 South African platinum mining companies, and we're currently funded by the 6 that are shown on the left. And our brief really was to increase global platinum investment demand. And we do that in 2 ways. We provide data, research, insights to allow investors to make more informed investment decisions regarding platinum. And then secondly, we try to make sure that there is the platinum investment product that's most appropriate to the investor concerned, be that a listed instrument like an exchange traded fund or a physical bar and coin, but equally we engage investors that invest in futures, swaps, equities, and the like. Some of the partners on the right, for example, the Royal Mint has now issued over 60,000 platinum bullion coins, mainly into the North American market. And in 2017, we opened an office in Shanghai, and we work closely with partners there that produce retail platinum bars for investors, and also we're working closely with the banks. So on the next slide, let me turn to the platinum market, which is about an 8 million ounce market annually, or 250 tons. And on the left waterfall chart, we can see that supply in 2020 fell quite heavily down to below 7 million ounces. And that was due to COVID impacting mining operations in South Africa, and also unrelated to COVID, a processing plant that was out that took total supply down by close to 1 million ounces. So in 2021, we expect that the large green bar to recover by 1 million ounces. The other bar on the far right, recycling, has only recovered a small amount, mainly because of the high price of palladium and rhodium limiting working capital in that area, and some constraints in refining. So supply back to about 7.9 million ounces in 2021. And then on the chart on the right, we know that obviously COVID affected things like automotive sales, jewelry sales, and certainly industrial activity. And they were all heavily down. And we can see in 2021 strong recoveries from jewelry, and importantly, automotive and industrial have recovered higher than pre-pandemic levels. And I'll mention why shortly. Investment demand, although it's below the record last year, is still over 700,000 ounces and above the 5-year average. So just looking at the next slide to say, well, what was the consequence of what played out in that very complicated year, 2020? If you look at the top left chart, we can see the quarterly platinum global supply-demand balance. And you can see on the right, you had 3 consecutive quarterly deficits during 2020. And that certainly was part of why that platinum price increased from around the $800 an ounce level, where it had been stuck for some time, to the $1,100 to $1,200 ounce level. And you've had a 4th consecutive quarterly deficit, albeit smaller, in the first quarter of 21. If we look at the right-hand chart, what we can also see there is that you've now had 3 consecutive, or we're expecting the 3rd consecutive deficit in the market in 2021. And in 2014, there was a deficit and the price went down. And a lot of people exclude investment demand from the supply-demand balance. And right now, however, that seems to be more relevant to price discovery. So in terms of where the price will go and how you can take a view on whether to lighten or increase your ownership of platinum, if we just look at the next slide, there's an interesting dynamic. The fact that supply is particularly constrained. So on the left, we have the mine supply out of South Africa, and South Africa supplies over 72% of global mine supply. And we can see that red line is the basket price of platinum, palladium, and rhodium that's risen significantly since 2018. Now, despite those companies having extremely good earnings, they've gone mainly from net debt to net cash and performed very well. There isn't a single project underway at the moment that will materially change platinum output for the next 3 to 4 years. And that's quite significant. So all of those companies are now talking about expansion, looking at projects, and certainly trying to get them underway. But there's a long lead. So mine supply looks like it'll be flat for another 3 to 4 years. Recycling, people tend to expect recycling to be price elastic, but it tends not to be. The price of palladium and rhodium escalated massively in 2018 and 2019, and that supply has gone up very little. And that remains a function of the loadings of when the vehicle was manufactured. So turning to the next slide in terms of price effective platinum, the top left chart is actually a palladium chart, and that's the NYMEX futures chart. And you can see if you go back to 2019 and before that, the short-term changes in the palladium price were very much driven by the NYMEX futures market. And you can see just before the pandemic, that gray area, the long positions, came down heavily, yet the price increased. And equally, we saw when the price of palladium collapsed along with prices of everything else, it came back very quickly without much activity from the futures market. And what we believe is behind this is that the automakers in China don't have forward books for their metal. They're state-owned joint ventures. And what it means is that they buy in the spot market for near-term use. And you can see that the futures positioning hardly increased in palladium, yet the price was extremely strong. Now, what we're seeing in China is that the increased use of platinum in heavy-duty trucks and substitution for palladium, as well as strong industrial expansion, means that there's a lot more platinum being imported into China, hence a tighter market. But importantly, the same effect is happening now, that you're getting very small, in fact, a decline in futures positioning, yet the price has increased. And we think this year that automotive spot buying in China has been elevating and supporting prices in the current range. And we think this is a dynamic that will continue to increase. The next slide and second last point is probably the most important aspect to platinum's demand growth. What we see on the left is that the price of palladium went above platinum in 2017, and it's been around $1,000 to nearly $2,000 an ounce more expensive. It's a one-to-one substitute in a gasoline catalyst. And on the right, the automakers have been talking about vehicles that are on the road where the catalyst contains palladium and you want to replace that with platinum. That's quite a slow process, and you can see that blue bar grows over time, but it's a material growth. This is a market with supply that's flat, and this is an additional 1.5 million ounces in 4 years' time. What we've also flagged is that there's 31 million vehicles in Europe and China that had to comply with new emissions by January this year. And those, the metal could have been substituted already. So the gray bar, we think, could be quite a lot more. And we think investors are starting to react to this. So in summary, and it does talk on the next slide to the original question, is that, how should you consider platinum? If you look at those price charts on the left, I think we've heard a lot about gold. Platinum traditionally traded at a premium to gold, certainly post any recession. And certainly that's undervalued. It's undervalued compared to palladium for substitution, and certainly infrastructure spending from all the fiscal stimulus. You can see what copper has done, and platinum is lagging that slightly. So I think significant near-term demand growth with constrained supply, upward pressure from that automaker buying in China. And then there's the significant strategic role that platinum has in the hydrogen economy. So we think those reasons are why the outlook is significantly strong, that both automotive demand growth plus strong investment is likely to continue with sustained deficits and certainly upward pressure on price. Thank you very much, and I'll hand back to you, Nikos.
Thank you very much, Trevor. As always, also very insightful and interesting. I would like now to move to our last, but certainly not least, participant, Bart. If I could invite you to please share your thoughts on the silver market with us. Bart, you're still muted. There we go.
All right. I hope you can hear me now. Well, good afternoon, everyone in Singapore, and certainly it is a good morning here in Toronto, Canada. I will talk about silver and explore some of the market dynamics we have seen with silver, which is quite often thought of the poor man's gold, and we've seen silver outperform gold. And I think one of the fundamental questions I'm going to try to address towards the end of the presentation is, can silver perform well even if gold were to have a bit of a correction if the Federal Reserve and other central banks around the world tighten monetary policy? I think you might know the answer already, and it is yes. And just to go back on the general theme of this, I do think there is a place for silver, gold, and precious metals generally in portfolios. They are very, very good stabilizers, and they have performed very well in this cycle, in previous cycle. When we hit a liquidity crisis, well, over a year ago now due to COVID, gold did well. Silver not so much, but then we had a very, very strong rebound and outperformance. And I think I'll start with the relationship between gold and silver. So as I say in my subtitle here, after a period of underperformance, silver is getting its bona fides back. It is looking much, much better, and there is hope it will do better still. And we do think that within the next 12 months, it wouldn't be unreasonable to see silver at some $30 sometime in between that period. One feature of silver is that it has roughly double the volatility of gold. And that typically means that when gold does poorly, silver does really, really poorly. And when gold or the precious metals environment is good, conducive to high gold prices and investing in precious metals, silver outperforms. And that's exactly what we've seen. And just to give you a case in point, during the depths of the financial crisis, when we had massive liquidity issues, even on the treasury market, silver dropped significantly more than gold. I think we hit a mark of $11 or so from the peak just prior to that, to the trough, some 36%, certainly underperforming gold at that time. And of course, when you look at the right-hand side of the gold price and gold silver price ratio, you see that manifest in, I think, one of the highest ratios, at least in recent memory, of 124. Now, of course, you see that ratio, the gold to silver ratio, drop, and that is just indicative of silver's outperformance. So what happened? Well, just over a year ago, we've had COVID, massive shutdowns. We had no idea how to handle this virus, and there was just a sense of panic and foreboding, and everything was essentially sold to provide liquidity, to cover margins. And it was a very, very bad time. Even gold, the quintessential hedge, had a bad time of it. But then on I believe it was March 23rd, something happened that has never happened before. The Federal Reserve essentially gave the market unlimited liquidity in the form of QE asset purchases. Now, if you all know, we're at $8 trillion balance sheet held by the Fed. The ECB has somewhat less, but then, since that, we've had a massive injection of liquidity. Risk assets did extremely well, and so did gold and silver, silver outperforming. So what happened? I think for the same reasons that investors bought gold, they also bought silver. And just after that time, we've seen net exposure, net short exposure on, as recorded by the CFTC, start turning into net length. At the same time, as prices started moving higher, CTA, Commodity Trade Associates, algorithmic traders, also started to materially move away from short exposure toward longs. And that triggered technicians. And we've also seen a massive amount of silver investment, not only in metals and coins, which I think we estimate of 200,000 ounces, but we've seen massive ETFs, I think for 2020, 331. Now, that was enough to move things along, and that happened even though there was quite a material decline on the industrial side. So industrial demand across the board dropped, but at the same time, something that certainly I missed in my projections was that the mining sector produced a lot less silver than in 2019. So 2020 was a bad period for silver production broadly. So that served as the big offset to declining industrial demand in 2020, but investment took over. And as it turned out, we estimate that when you take ETFs and all the flows into account, there was 240 or so million ounce deficit. We're also projecting a deficit in 21, where we're looking at less investment activity, but improved industrial activity, but still a deficit. So if we could turn the slide. And you see that demonstrated here where 2020 looks pretty dismal on the demand side, and 21 looking better. And we're also, we think after the 23.4% decline on the industrial side in demand in 2020, we're going to get roughly 14% increase in 21 and somewhat more normal increase in the form of 4% in 2022. On the right-hand side, you're just looking at the relationship between ETF holdings and the silver price, and that makes a lot of sense. Typically, the higher price, the more ETFs. I'm not sure which way the causality was, exactly, but we do think it was the price driving the ETF, and sometimes the ETF, the price, it wasn't always consistent. But I think we can say with a high level of confidence that CTAs and other speculative investors probably contributed a lot to this price rise. Next slide, please. So when we're looking forward, there's some interesting questions arising. One I always get is, how is silver? Why is it silver trading at the very top and of the cost curve? And the answer, I think, is plain at this point, that given the pretty significant investment inflows and considering fairly lackluster mining activity or CapEx, we're projecting deficits, and ultimately it means that it is possible to function at the very top of the cost curve and even above if scarcities proceed. Certainly a metal like palladium could be the future for silver down the road. As we look at 5G demand, automotive demand, the use of silver in hybrids and vehicles that are all electric, much higher loadings of silver. Power cells all require that metal, and some new technologies like cold sintering will also drive it. So it is not all sure that we're going to get a significant rebound, a rebalancing the market. So it could very well be that long term, the mining sector doesn't keep up with demand. Next slide. We don't think that's the case right now. This recovery has very much been a macro recovery where the Federal Reserve continues to follow the zero bound, we think, well into late 23 and most likely, likely into 24. We have to remember that with the increase of labor force in the United States over the next 2 years, the US is missing some 9 million jobs. That means 380,000 jobs a month needs to be created every month for the next 24 months. And it's very interesting that the US Federal Reserve is now targeting employment and is less concerned about inflation. And they are having average inflation targeting policy with a big skew to full employment. So our belief is that real interest rates, which we think are a big driver of investment demand, will be with us for quite a while. So negative rates will ultimately be good for precious metals broadly, and that includes silver. But silver gets the added bonus of industrial demand, since some 60% plus is industrial demand. But I don't expect a surge beyond $27, $30 that we have in our near term or midterm time horizon just yet. There's still a lot of inventories, as you see on the left-hand side, that can be deployed, probably less than people believe, because a lot of that metal is allocated and cannot be sold and bought and swapped. But fundamentally, in a crunch, we could see supply, and certainly the evidence now points that we're not seeing any significant premiums regionally, nor for any industrial grade of silver. Next slide, please. And just getting towards the end of my brief presentation here, one very important thing about silver is, and it's quite unique to many metals, well, maybe not palladium because much of it is a byproduct, but most of its supply from the mining side of things is from other metals: lead, zinc, copper, gold. And that typically means that silver supply is not particularly price elastic. So you can have high prices, but that doesn't necessarily mean you're going to get a robust supply response because, well, let's face it, vast majority of it is from byproduct mining. And when we look at capital expenditures for the key metals that you know are polymetallic with silver, zinc, nickel, lead, gold, copper, there is very, very, very scant capital at CapEx. You know, there are many questions that that brings whether we can actually go full throttle with CO2, you know, net neutral carbon dioxide economy by the targets a lot of people are setting, because these metals are required. But in the case of silver, it's going to be very tough to robustly grow silver demand if we're not seeing CapEx in byproduct metals. So if the demand longer term we were talking about because of 5G, of higher loadings in you know, vehicles, new technology that replaces solder and so on, could very well mean that we can have a scarcity situation where we are at the very top or even beyond the silver cost curve. Granted, for a few years, we will be very dependent on investment flows because those are the ones that are generating the deficits in the broad market. But we've not seen any evidence that those reverse very quickly. It seems that ETFs aren't all that elastic. Once silver gets in there, it doesn't necessarily get out as quickly, which has helped to keep silver relatively stable. Next slide, please. And this is just the price forecast that TD Security has. Take a look at it. I'm not going to go through every one of them, but I think I'd like to end on this note, and thank you very much for listening.
Excellent. Thank you very much, Bart. And I think it's safe to say that you definitely won the award of the best title for a presentation so far. Silver indeed has gained. I would like now to invite all our panelists to join this so that we can have a bit of a discussion. We've had a fair few questions come in already, and please, to our attendees, keep them coming. If I could trouble you, John, first. I have a question for you about mine supply, and specifically about this idea of peak gold. I've always been quite skeptical towards these any concept of peak ... and add any commodity you want there. But I just wanted to get your thoughts. How do you? What are your feelings about peak gold? Notwithstanding the possibility for mine supply to decline in the next few years, what are your thoughts about the theory or the applicability of it to the gold market?
I mean, I'm a bit like you, Nikos. I've always been skeptical about claims that we're running out of any commodity. The best cure for a shortage of supply is higher prices, and at higher prices, projects that previously weren't profitable become profitable, and obviously as prices go higher, it encourages companies to spend more on exploration. But there are some factors which seem to be playing a role in at least I think, fairly strong arguments that we will see mining companies, particularly the large listed developed market mining companies, struggle to grow production. If you look at exploration spending, it's been high, but if you look at the success rate, it's been pretty low. There haven't been many decent sized discoveries in the last 10 years or so. If you look at some of the projects that are known out there, some very large deposits that could contribute fairly meaningfully to supply, they have some very large price tags on them. And there's no real sign yet, I think, of the mining companies having sufficient courage to go ahead with some of these very expensive projects. So if you look at the pipeline of projects coming along for the next few years, and you think about depletion from existing mines, I think it's credible to question whether mine supply can keep growing. I've seen some work done based on these pipelines that suggest that gold production will peak 2022, maybe 2023, and then decline at, I don't know, 1-2% per annum thereafter for the next for the foreseeable future, I would say. But we've heard these claims before, and I remember after the last cycle, there was the expectations that we'd see mine supply declining, and eventually it did happen, but it seemed to take a lot longer than everybody was expecting. And I think part of that is because of smaller scale mining and artisanal mining as well, which from all accounts is growing quite quickly at the moment because of the high gold price. So I do have some concerns about project pipelines, and depletion is obviously an issue, but I don't think we're going to run out of gold to mine anytime soon, perhaps not to see the growth that we've seen over the last decade or so.
Thanks a lot for this, John. And for what it's worth, we would also see, maybe not in 2022, but our medium-term forecasts, which I'm sure you've seen once or twice, also show certainly the growth slowing down dramatically in the next couple of years, and then at least for this cycle we see a peak, but in line with your comments and certainly the experience that we've had over the years, the word peak is quite strong.
I would like to add, Nikos, that I pretty much agree with the both of you and John. What we're seeing in the mining executive suite and among investors that we talk to, they will tell you they love commodities. Many of them are very much enamored with gold, platinum, and silver. They are metals of the future, particularly some of the industrials which are seen to be key to decarbonizing the global economy. But what we've not seen is any serious commitment to grow capital expenditures. The concern is that we've seen this before. Prices are extremely volatile. Palladium was a case in point where we hit 3,000 and then 3,000 no more. The problem is that many investors simply don't have the confidence that this is for real and that supply is really coming off and prices will stay. And the issue is when prices do actually move high enough, it will take a very long time to get new capacity. 7 years is not at all unusual to bring new physical mining on site. So I'm afraid in some of these metals, certainly the ones that are, have demand that's price inelastic, like platinum, palladium, where you don't have, where you have regulatory requirements, you can't build a car without it. So demand stays, so you might have to ration. Silver could face the same thing. Gold is a little different, mainly because there's a lot of supply of it and it's interest rate driven to a same extent, but the same argument physically works. You're not gonna get supply anytime soon. So by the time CapEx goes in, we're 5-6 years too late. So this could be a very serious trend. We've not seen it to that extent in previous cycles, that reluctance to put money behind it.
Yeah, very good point. which in many ways applies to all of our all of the precious metals to a varying extent. If we could move back to demand, though, and Trevor, if I can trouble you for your thoughts on how you mentioned earlier, you touched on the hydrogen economy and its importance on sentiment. How important do you think platinum's role in the hydrogen economy is to platinum's fundamentals, and ultimately also the investment case for platinum? And if you could also give us your thoughts on timelines, horizons. We're not going to hold you to them, but
certainly, Nikos. I think, yeah, thank you. I mean, the issue with the hydrogen economy is that I think the world has focused, particularly in the last year, on sustainability and certainly on decarbonization, and that's had a couple of interesting developments. I think the fact that the hydrogen economy can result in decarbonization is interesting, and it's changed the debate, certainly around hydrogen initially, that said, if you do want to decarbonize, then your hydrogen production has to be from green sources. So green hydrogen, the topic of green hydrogen says that if you use wind or solar and you produce hydrogen from water, and you put that hydrogen into a fuel cell electric vehicle, then that is carbon free, and that's certainly appealing. What it also did, though, is it said that it actually put the spotlight on battery electric vehicles and said that a battery electric vehicle can really only be green if the electricity charging the battery comes from wind or solar, and that's a lot harder. So I think the edge has been taken off battery as a possible decarbonizer, because it isn't, and certainly elevated fuel cell in the hydrogen economy. And platinum is really in the sweet spot. It does two things. Firstly, you can use platinum electrolyzers to produce hydrogen from water, and that is the preferred technology, limited a bit by iridium, and that's very interesting. So it's a critical producing green hydrogen. However, over the next 10 years, probably the platinum used in that aspect is probably only a few 100,000 ounces, not very exciting for investors. The longer term prize of passenger vehicles, and if you go to 10 years time, certainly there will be a lot of battery vehicles, but there will certainly be a lot of fuel cell electric vehicles. And that's probably another 2 or 3 million ounces per annum of platinum demand on an 8 million ounce market. So that's really important. It's important to South Africa's supply. And you were talking about supply just now, and what you've got the situation is that you need policy certainty, and particularly in China, they are converting to the hydrogen economy because they need to. They've got the commitment to fuel cell vehicles, and the information flow appears that that demand could be there in 10 years' time. In the interim, it's probably the heavy-duty fuel cell truck that will lead to some significant platinum demand. But then the last point you make, Nikos, is really the most important, is that what we've been doing for the last 6 years is trying to get more funds around the world to consider platinum as an investment asset. And many of them looked at it. There wasn't an exciting demand growth story, and they just parked it and put it on hold. It's got some appeal. Palladium and rhodium have been fantastic. Gold has done well. But when those investors have heard about platinum's involvement in the hydrogen economy, they come back and they have another look at platinum. And what they see is not lots of ounces going into platinum for the hydrogen economy in the short term. They see constrained supply for at least 3 to 4 years and massive demand growth in automotive and industrial. And that's why we saw last year, record investment demand. In 2019, we had nearly 1 million ounces going into platinum ETFs. In 2020, we had 500,000, but that included 300,000 selling from South Africa and 800,000 from North America and Europe. So it's quite an interesting thing is that the hydrogen economy and the interest of platinum and its important role is driving very strong investment demand. And with the tight market we've got and demand growth, I think that's very material to upward price pressure. Thanks, Nikos.
Thanks, Trevor. I actually have a follow-up question, if you don't mind. I appreciate this starts to get into the more, let's say, blue sky thinking side of things. But let's assuming the best case scenario for platinum, and we do get those 2 to 3 million ounces of demand from the hydrogen space. What are we going to do to supply that? What do you think the producers in South Africa can do? Well, not just South Africa and around the world. What do you think the recyclers can do? Can we really fix that? Because, you know, with rhodium having topped $30,000 an ounce recently, and palladium also having reached all-time highs, we're all acutely aware of what can happen when suddenly you have this almost non-linear change in the market dynamics. Can we fix this, or will this actually end up fueling demand destruction elsewhere once the ETFs have been consumed by fuel cell manufacturers?
Thanks, Nikos. I mean, it's a critical question. And interestingly, if maybe look at it from the point of view of the industrial user, if you were somebody investing heavily in fuel cell electric vehicles, will there be enough platinum in 10 years' time? Is this a really difficult decision? And interestingly, we know, as Bart mentioned, that palladium is largely a byproduct. The palladium price has gone from $300 to $3,000, and there's been no supply response. However, platinum's got a diverse demand use. It's got jewelry, it's got a lot of industrial, and it's got automotive. So the issue here is that two things are necessary. Firstly, policy certainty. And what we're seeing in China, where people had already converted truck fleets in their cities to improve the air to battery, they're now converting every battery vehicle into a fuel cell vehicle. They don't need to do that for air quality, but they need to do that for their fuel cell industry to enable them to roll out fuel cell vehicles into the north of China, where it's very cold, and in very cold weather, battery vehicles just don't cut it. So that drive means if China's got policy certainty, and what we saw was the Biden administration committing to the Paris Climate Accord in the first week. So there's a serious commitment by the world. And what we think is that that funding will go in the short term to reduce the cost of producing green hydrogen. And if that gets down below $2 a kilogram, suddenly it's more attractive than fossil fuels. So I think policy certainty will mean that the South African producers will have 10 to 15 years to grow their output by 3 million ounces. And we've got a good track record that when Europe's vehicles went from 30% to 50% diesel, the South African mines expanded because they had policy certainty. So I think policy certainty in China, Europe, and the US on the hydrogen economy will give South African producers the courage to expand. There's plenty of reserve in that ore body, certainly 100 years at current usage. And that can be coupled quite quickly. And the nice thing is that if the supply doesn't match that demand growth, you've got a few million ounces of platinum that's going into jewelry. So your price can rise and not destroy demand, but it can move the metal directly from jewelry into fuel cells. So we think this is a very good long-term combination, particularly for industrial investment. Thanks, Nikos.
True. Well, thanks a lot for that, Trevor. Bart, I'd like to ask you, it's actually a bit of a dual question. So first of all, can you tell us how important do you think ETF holdings or ETF flows are for silver price discovery determination? And if you could sort of specifically look at recent reactions of ETFs to prices, how, you know, in contrast to gold, in spite of price fluctuations, we haven't really seen much going on the ETF side. And then if you could somehow link that into what you see on the scope for silver to outperform gold, given this, let's say, more inelastic nature of investment demand, and where you see the relative valuation between the two in the next 6 months, 12 months, whatever your preferred time horizon is. You're still muted.
I do have to say, you know, as fabulous as this platform is, I do prefer in person, and hopefully in a year's time we'll do it, you know, in physical form. That's where I think I excel. I probably won't have to mute myself then. Look, as a matter of driver, I think it's the real interest rates, the monetary policy factors, and inflation expectation, all that stuff, I think, is a primary driver of price, which I think tends to move flows into ETFs. I don't think it's the really ETFs that drive the price initially, but it is a bit of a virtuous cycle. You know, you get the macro side, you get the monetary side, getting prices moving. You know, usually gold starts off, and then these correlation trades start happening as from that volatility chart, and then you have a more robust silver response. But when we looked and stress test ETF holdings to price changes, and as you mentioned, they're not that particularly elastic. It's like I call it the Hotel California effect. Once it gets in, it doesn't get out. And that is a very good thing, because when you get a demand shock of some sort, and maybe a price correction, you don't necessarily get a massive outflow of silver that can turn a deficit market into a big surplus with, bunch of silver trying to find a home. And that has been, I think, somewhat of a stabilizer. In fact, we often on the trading desk refer to silver as the devil's metal, and it hasn't been as devious as it has been in the past. And I think I think I said it getting its own bona fides, and I think that's probably true. It's increasingly seen as a metal that's going to be transformative of the economy, moving over the long run. We're not talking about the next 2-3 years. Certainly, I think it's wrong to say that the quest for a CO2-free economy has been driving it. I think this is more of a cyclical development in the next year or two. But over the long run, I think silver can decouple from gold. I think that's feasible, mainly because we are not going to be dependent so much on those investment flows to balance the market. I can certainly envision a situation where we are in a tight market formation because of industrial demand growth, and given constraints on the supply side, investment flows will become less and less relevant as a proportion of total demand. And given its relative stability, it can decouple. As higher demand is in there, you have the investment side not necessarily increasing all the time, but fairly stable, and that means pretty much independence from gold. So I think silver can do well even if gold were to have a bit of a correction. I think that's more for beyond my current forecast horizon of 2022, but I think that is coming very much like in the PGMs, palladium in particular, where it marches to its own drum. It's a precious metal, yes, it has a lot of those characteristics, but its industrial side, it tends to drive it more than any macro considerations.
Great, thank you very much, Bart. John, I have one for you from the crowd. It's a bit of a complicated one, but hopefully you can share your thoughts on this. I know you guys are doing a lot of work on the policy side. How would you expect Basel III to impact financing of gold?
Yeah, Basel III has been a big topic. There's some commentators saying it's actually going to be remarkably positive for gold. But I think those are people that are outside the precious metals industry and don't depend upon gold financing and the ability to borrow gold or to lease or to swap currencies for gold cheaply. I think the short answer is we don't know. It could have no effect, but it could have quite substantial increases in borrowing costs and a reduction in the availability of metal to borrow. And in a way, we're really only going to find out as time passes. Lots of conversations with the banks that primarily will be affected by this gives you very mixed answers. Some say that they'll be fine. They've got sufficient high quality liquid assets on the balance sheets that they won't be massively affected by the increased capital requirements to hold precious metals. Others seem either less prepared or maybe even less confident about how things will work out. I'm less worried about it than I was perhaps 2 or 3 months ago when we started to look into this in more detail. But I think there's a fair amount of uncertainty here. You know, in time, I think the problem will probably go away now that we have much better data provided by the LBMA in terms of trading volumes and other data that will allow assessment to be made about gold's true liquidity. But for the time being, I think there's a fair amount of uncertainty, and there is the potential, I think, for financing costs within the gold sector to go up quite a bit. And of course, it's not just gold that this applies to. I believe that this applies to all commodities, and with some commodities that genuinely don't have a liquid market, I think that they might find this a bigger problem. But you know, it's a topic that, as I say, is very much on our minds at the moment. And for those of you that are interested in reading more formal description of what's going on, I would encourage you to go to our website, where Andrew Naylor, who runs public policy for the World Gold Council, published a blog on our Gold Hub blog a few days ago, and it's I think it sets out our views very clearly.
Wonderful, thank you, John. I think it's time now to have a look at we still have a few more questions, but so that we don't run out of time, I would quite like to show the poll results from the questions we asked. So could I please ask our wonderful organizers to put up the slide? Well, I suspect we may be having technical issues with this. So one more question for Trevor in that case. Trevor, during the recent Platinum conference that you guys co-sponsored, co-organized, there was quite a lot of talk about substitution of palladium into platinum. So switching of palladium to platinum, given the price differential of the two. Could you comment on how long you think that will take to ramp up, its impact on prices, and also, do you have any wise words as to where we can get accurate information on the sort of volumes we're talking about?
Well, thank you, Nikos. Yes, also a very big topic and very material to platinum demand growth. So, you know, we'd flagged in 2018 that substitution could happen quite quickly, but the automakers and the makers of catalysts said, no, it's going to take a long time. I'd worked very closely with Johnson Matthey, and what we saw in 2000 was when the palladium price went to $1,000 an ounce. Over 3 years, there was nearly 1 million ounces of platinum that went back into gasoline catalysts. So we know that that was done before. And then when rhodium went to $10,000 an ounce in the mid-2000s, we saw its aggressive substitution of rhodium with palladium at a 5-to-1 ratio. So this substitution happens on the wash coat, which is the coating that's on the catalyst in the exhaust system. And that wash coat can be changed quite quickly. I think the automakers know exactly how much substitution is happening, and so do the fabricators, but that's really proprietary and confidential information. And if they had given any indication to that, what it was likely to have done was increase the input cost of platinum into those catalysts, and the amount of substitution probably wouldn't have solved the massive palladium deficits. So it's been very confidential behind the scenes, and my understanding and my deep involvement in both the substitution of palladium and rhodium leads me to believe that it can be done really quickly when you're already changing an emissions control system on a vehicle. So what we've had recently is a lot of information flow, and I think that's been driven by this, $30,000 rhodium and certainly $3,000 palladium. And suddenly they've been talking about the fact that substitution can happen, almost to suggest that palladium will be able to replace some rhodium, but first you'll need platinum to replace the palladium. So the public information flow has been very, very slow. What we've tried to point out is that on those vehicles, and mainly the Euro 6D vehicles and China 6A and B vehicles in China, there's 31 million vehicles that had to have all complied with a much tighter legislation by January. And when that's happening as the vehicle's being developed, you can change those ratio of metals quite easily. There's no additional testing, there's no additional certification. And certainly that could be done without much public disclosure. So we think it's happened. We think the vehicle volumes in 2020 has clouded that information flow, and it should come out in the next while. So unfortunately, there's nothing available easily publicly. But having had this discussion around the 1.5 million in 4 years' time, we think there's a lot more that's going on. And certainly we think investors understand this, and that's where the strong investment demand has come from. So thanks. I hope that helps the question, Nikos.
Thank you very much, Trevor. It certainly does. And we now have the results of our polling. And as you can see, even our paychecks depend on it. I think we'll all be delighted to see that the majority of attendees are still committed to the precious metal space and do not think it's time to trim exposure. Although at nearly 1/3, there is a pretty vocal minority in the background as well. We also asked attendees for their thoughts on which metal will be the strongest performer through to the rest of the year. And for this question, we can see we have a bit of a tie. Gold and silver are literally identical, with platinum being the next in line. And it looks like there's not that many bulls on palladium at the moment. Only 2.3% of votes feel that palladium is the outperformer. So there you have it. I think we're coming close to the end. I would like to, first of all, I would like to thank the panelists for taking the time and for sharing their thoughts and insights. I certainly got a lot out of this session, and hopefully hopefully the rest of the attendees also did. And I would like to close this by asking each of you to just one sentence, tell us all what you think the single most important driver for your respective metal will be over the rest of the year. Is it inflation? Is it real rates? Is it substitution, hydrogen? Just so that everyone that's watching us can also keep an eye on that indicator. John?
I hope it's real rates. I really do, because the other thing that gold can drive gold higher is unexpected shocks. And I think we've had enough of those for the last couple of years. So let it be real rates.
Nikos, I can just for platinum, I think the fact that platinum is so undervalued compared to palladium, there's no palladium supply coming on anytime soon, China buying in the spot market. So I think the incentive to substitute is big, and platinum being undervalued and certainly undervalued against gold. If we look at the outperformance against gold. So I certainly think recognition of value, and at a very basic level, anybody looking for a metal that hasn't run, nickel, copper, aluminium, palladium, rhodium, everything's run. Platinum hasn't for no good reason. We think it's that recognition that'll probably drive it. Thanks.
Great. Bart, silver?
For silver, I'd have to agree with John. Real rates have been shown to be the biggest driver. I'll go a little bit perhaps prior to what is going to drive the real rates. I think Federal Reserve policy. I think it's going to be very interesting to see how the Fed signals tapering, probably starting even today, and how big that tapering is. Our suspicion is they are going to be very, very careful how they manage this, and they have a huge task ahead of them. And real rates, in my view, are going to remain very accommodative, very firmly in negative territory, with growth slowing broadly, as we've seen the last few days in terms of employment growth, in terms of retail, and inflationary expectations may move up and rates will be low. So a very good environment for precious metals, gold, silver, at least for the next few months.
Excellent. Well, thank you all. And with this, we've literally used up all the time we had, and I would like to pass it back to Vatsa.
Thank you, Nikos. Thank you very much. I must say I enjoyed the session every bit and learned a lot from this very experienced panel. Thanks also to the clarity that's it's perhaps time to stay invested and perhaps add more precious metals to one's portfolio. I think all the panelists, Mr. John Reed, Chief Market Strategist, World Gold Council, Mr. Trevor Raymond, Director of Research, World Platinum Investment Council, and Mr. Bart Mellon, Head of Commodity Strategy, TD Securities, have done a wonderful job in educating and enlightening us. Special thanks to Mr. Nikos Kavalis, Managing Director, Metals Focus Singapore, for making this session very lively as session chair. Thank you very much. Do take time in the networking launch. Maybe some of them would like to interact with you in person. If time permits, please do stay and networking session, and many would like to interact with you in person as well. Thank you so much to all the speakers of the last session, demand, supply, and price of precious metals. Thank you very much.
Thank you.
Thank you very much.
And I also request, if it is possible, all the speakers who are staying on, to take a nice picture and send it to us. So it will be useful for our souvenir, which we are planning to prepare. Thank you very much. With that, we come to the end of the conference agenda of day 1 of the virtual Asia Pacific Precious Metals Conference 2021. Please note the networking launch and the exhibition booths are open for another 2 hours. So continue your networking and enjoy the rest of the evening. Please note, day 2 of the conference would start at 2:30 p.m. Singapore time, half an hour earlier than today. Don't miss the special session on China, curated by Shanghai Gold Exchange International. The session would have rich experiential sharing by experts from Bank of China and Chow Tai Fook. Besides, we have a special presentation on ASEAN macroeconomic trends, which is very useful for all our business, a debate on gold versus cryptocurrencies, and as usual, a very, very signature event of our conference, the Technology, Innovation, and Ecosystem session, as a last and concluding session for tomorrow. I'm sure you would enjoy day 2 sessions as much as you have enjoyed today's sessions. And please note, networking launch for tomorrow would be open from 11 a.m. Singapore time. So you can schedule your meeting for tomorrow with sponsors or any of the delegates. Should you need any assistance on how to reach out to somebody in specific, please do contact the help desk. So keep browsing around and have a great networking session ahead. See you tomorrow at 2:30 p.m. Singapore time. Till then, best wishes. Have a wonderful day ahead. Thank you. Here is some memories from the past. Hope you like this video. Thank you very much. It was a very special compilation, and we hope to see you all in physical conference next year. But till then, please do join us tomorrow at 2:30 Singapore time. Thank you very much.